Well, I think the Fed's going to take its cues from the market. And what you're seeing is when you look at the 10-year now going under 2.4, you see the 30-year collapsing as well. The whole yield curve is telling you that something's going on. And when you have a trade war or the hint of a trade war, it has an impact on GDP growth, not just here, growth around the world. And that's what you're pricing in right now, is that this is not going to be an easy resolution. As Axios just reported, it doesn't appear that we're very close at all, and maybe we might not be done by year end. That's going to have an impact on global growth, supply chain around the world, not a positive impact. Unlikely that we'll see a rate increase. I am leaning more toward a rate decline sometime this year.
Sri, what do you think? You think rates are going to come down. Do you think the Fed's going to lead that process, or is the Fed going to follow the bond market?
The Fed is going to follow, I think, both the bond and the equities market, Tyler, even though it is supposed to follow the economy, economic growth and inflation. What we saw in December, January was that the Fed followed the stock market. In 2 weeks, we went from 2 rate hikes in 2019 to no rate hike at all. Nothing much happened with the economy during 2 weeks. So I think the same thing is likely to happen, and I think a rate cut could even happen by next month's Federal Reserve Board meeting, June 18th and 19th.
You think there could be a rate cut that soon?
It depends on how the trade war develops and how much you have the stock market fall by then, and if it does, then the Fed is going to react.
How do you look at it? Another 5% decline on the stock market, 10% decline in the Fed steps into action, despite what the Fed funds futures say?
Absolutely. That is exactly what happened in December and January, Melissa. You had the Fed all primed up, and you had a big drop in the equity markets in the second half of December, and the story changed on January 4th when you were looking for no rate hike at all.
That seems like a little bit more than I would ever imagine would occur. I mean, it would take much more than a 3 to 5% drop in the market. We've already experienced that. I think if we had a 15 to 20, and I don't see any reason why that would occur. Remember, the end of the year was a very unique time. There weren't a lot of market participants. You had a lot of selling, a lot of chaos going on, not just because of what was happening with interest rates, but also the talk about China and the fact that we did not have a lot of market supply. So, I think that's highly unlikely. We are due for a correction after the recovery. But I think, again, the Fed is unlikely to step in to save it if it's just a normal 5 to 10% correction, which I think, again, is unlikely because we've had most of the news. Most of it is priced in. So my expectation is that around the fall, late summer, if we haven't got resolution, the markets are still a little wary. I don't think they're going to be compelled to act unless we start seeing something that really starts to affect the economy.